Okay, let's talk about the risk premium. We're going to talk about risk some more. We're talking about the risk premium and the difference between investing in risky things like stocks or risk-free things such as treasury bonds. Now, treasury bonds, treasury bills, the federal government has a printing press. So the reason they call it risk-free is because they can print money and pay you back your money no matter what. They have that advantage. Nothing else is as risk-free. So treasury bonds, when we say risk-free, we're really talking about treasury bonds, bills, and notes, and holding them because you will get your money back because they have a printing press. They can always print your money. Will it be as valuable? No, that's inflation. That's a whole different type of risk. But will you get your money back? Yes, that's why they call it the risk-free rate. So we have a rate on treasury bonds, and then we have our risk in the market, and we have a return in the market. But we also have a lot of volatility in the market over time. So we have to take a look at both of these. So let's look at the first slide. It says U.S. government securities have very low volatility or risk. The government is considered risk-free because it can raise taxes to repay it or just print money to repay it. This is treasury bills, which have a discount or a discount bond that mature less than a year. So the rate of return on security is called the risk-free rate. The risk premium is added to that as a form of reward for bearing risk. So if you could get 12% risk-free and the return on stocks was 11.8%, why would you ever buy stocks? They give you 12% with no risk. Why would you ever buy a stock? Well, clearly that's not the way the rates work, right? So right now, when I'm filming this, the risk-free rate is almost zero. The interest rates are extremely low, and so that has forced a lot of people, almost everyone, to get into the stock market. And the stock market could be, some people would say it's pretty high because of that, and certainly the bond market is pretty high because of that. So the bond market's very high, the stock market's very high, interest rates are very low because there's nobody wants to get basically zero return on the risk-free rate. They start getting into more risky assets. And so this is something the Federal Reserve has pushed for in the recession of 2009-2010. They lowered interest rates very low to keep people pushed into stocks and bonds so they would still have money for the companies to continue to grow and to build new buildings and produce new lines and introduce new products and so on. So if the risk-free rate was 10%, then who would invest in a company? I mean, you wouldn't. You'd take the 10%. That sounds great. But if they lower it to almost zero, well, that pushes money back into these companies so they can try to do more with the money. Going beyond that, the Wall Street Journal suppose it said that Treasury bills is 5%. That's a suppose, it isn't. But if it was 5% and the historical average is 11.8%, we saw that in the previous section, then the risk premium would be the difference between the two. It would be difference between 11.8% for taking risk and the 5% for not taking risk, which is 6.8%. So the question is, are you willing to take risk to make 6.8% more? Well, if they drop the 5% to 0.5% or 0.25%, and the long-term returns are 11 or 12, 11.8 or 12% in the market, then all of a sudden you start thinking, oh, well, yeah, for 12%, I'm going to take some risk here. Well, that's basically what happened in the after 2008, 2009 downturn. Is the Federal Reserve dropped interest rates to very low, which forced people to think, oh, well, on average, I should do pretty well going forward as long as we're stable. And so once they figured out they were stable, money flooded back into the markets, and it's been going up pretty steadily with some little hiccups since then. So the risk-return trade-off general rule: the more volatile or risky a return is, the greater the return is expected to be. The key is expected. We talk about expected return. Expected, parentheses, return, not just return. We're expecting it, which means we talk about ex post and ex ante. Ex ante is ahead of time or now previous to the event. Ex post is after the event or after the whatever event trigger has happened. So we're talking about expected, which is ex ante. So it's previous to what could happen in the marketplace. So what's supposed to happen is we're supposed to get higher returns. Does it always happen? No. Risk statistics. No universally agreed upon definition of risk. Many different types of risk. We've talked about that in various parts of this class. In this case, we're going to talk about variance and standard deviation as a measure of risk. In other words, volatility. So how far off of the average? If the average return is 11.8%, how far off of that are you in a given year? Now, we saw the distributions of the returns. They're not quite uniform, but close enough to be uniform. We're going to count those. And so on average, how far off of that 11.8% are you every year? And what is the probability that the next year will be off by very much? That's what we can do. So we use variance and standard deviation as a measure of dispersion, volatility around the actual returns, around the mean. We use standard deviation as a standard statistical measure, and we use its interpretation to follow the normal distribution. Now, I'm sure you've all had stats, so a normal distribution you should be aware of, and so on. We'll get into that in a minute. The U.S. stock market risk premium has been substantial. Do we get particularly large returns? Well, in comparison to international markets, let's take a look at that. Greater than 50% of tradable stock is not in the U.S. 17 have an average risk premium of 7.1%, which is similar to ours historically, of 7.4%. So the U.S. investors did well, but not dramatically well. So let's look at individual companies or individual countries. Our average is 7.4. The total average of all these industrialized countries is 7.1, so we're a little bit above average. But you can see Italy, Japan, France, Germany, etc. are much higher risks than that, and Ireland, Canada, Norway, Spain are much lower. Clearly, this is prior to 2009's debacle, so this does not include the last 5 to 7 years, I wouldn't think. Yeah, this is right from your textbook. So these are the risk premiums that are going out then. Since then, interest rates have fallen dramatically, and the risk premiums have risen dramatically. Yes, exactly. So the apparent global market risk premium, it was 7.1%. That ours was 7.4 with a standard deviation of 19.6, and that means there's a 95% probability that the mean return is between 5.5 and 9.3. I'll show you that in a second. 226 financial economists estimate the market risk premium at 7%. So it's about 7% is what you get as compensation over the risk-free rate for investing in stocks. So if you invest in government bonds, you get 7% less than you would if you invested in stocks on average back then. That's the key. So let's keep going into the normal distribution and do some statistics.